Let me tell you about the biggest lie in personal finance. The lie that has cost retirees millions of dollars. The lie that financial advisors repeat because it sounds sophisticated and it generates fees. The lie is this, that there is some magical complex formula for portfolio allocation that changes based on your age, your risk tolerance, your goals, your astrological sign, and whatever else they can dream up to make it seem complicated. I have been investing for over 80 years. I have managed billions of dollars. I have studied every allocation strategy ever invented. And I am going to tell you something that will make most financial advisors very angry. There is only one portfolio allocation that actually works after 65. One. And it is so simple that you could explain it to a child. But simplicity does not sell products. Simplicity does not generate fees. So Wall Street has buried this truth under layers of complexity designed to make you feel like you need their help. Today, I am going to share that one allocation strategy with you. I am going to explain why it works. I am going to show you the math, and I am going to tell you why almost everyone gets this wrong. But first, let me take you back to 1993. I was 63 years old, approaching the age when most people start thinking seriously about retirement portfolios. I was sitting in my office in Omaha reading through a stack of research reports from the big brokerage houses. Every single one of them had a different recommendation. One said 60% stocks, 40% bonds for someone my age. Another said 50-50. Another had some complicated glide path that changed allocation by 2% every year. There were target date funds, balanced funds, allocation funds, lifestyle funds, hundreds of products, each claiming to have solved the retirement allocation puzzle. And I realized something that has guided my thinking ever since. All of these recommendations were based on one assumption, the assumption that volatility equals risk. They looked at how much stock prices bounce around compared to bond prices, and they concluded that older investors should own fewer stocks because they cannot handle the volatility. But volatility is not risk. Not for a long-term investor. Not even for a retiree who might live another 30 years. The real risk, the risk that actually destroys retirements, is running out of money. And ironically, the conventional allocation strategies that try to reduce volatility often increase the risk of running out of money. Let me explain what I mean with a simple example. Imagine two retirees, both 65 years old, both with $500,000, both needing $40,000 per year to live on. Retiree A follows conventional advice. He puts 50% in stocks and 50% in bonds. His expected return is maybe 5 to 6% per year, blending stock and bond returns. After inflation, he is looking at real returns of maybe 3%. Retiree B follows what I am about to share with you. She puts 90% in low-cost stock index funds and 10% in short-term bonds or cash. Her expected return is maybe 8 to 9% per year. After inflation, she is looking at real returns of 5 to 6%. Now over a 20 or 30-year retirement, that difference is enormous. Retiree A's portfolio grows slowly and may not keep pace with his withdrawals, especially if we hit a prolonged period of low returns. Retiree B's portfolio has a much better chance of not just surviving, but actually growing during retirement. But wait, you say, what about the crashes? What about 2008? What about the volatility? Will not retiree B be devastated when the market drops 40%? Here is the truth that nobody wants to tell you. Even with the crashes, even with the volatility, stocks have outperformed bonds over every 20-year period in modern history. Every single one. If you have a 20 or 30-year time horizon, and most 65-year-olds do, stocks are actually the safer choice because they are more likely to preserve and grow your purchasing power over that period. The short-term volatility is real, it is uncomfortable, but it is not the same as risk. Risk is permanent loss of purchasing power. Risk is running out of money at 85. Risk is watching inflation eat away at your fixed income bond portfolio year after year until you cannot afford groceries. Now, let me tell you the specific allocation I would use and why. 90% in a low-cost S&P 500 index fund. Not individual stocks, not actively managed funds, not sector funds or international funds or emerging market funds. Just a plain vanilla S&P 500 index fund with an expense ratio under 0.1%. Why the S&P 500? Because it gives you ownership of the 500 largest, most profitable companies in America. Companies like Apple, Microsoft, Johnson & Johnson, Procter & Gamble, Berkshire Hathaway. These are businesses that have survived world wars, depressions, recessions, pandemics, and every other crisis imaginable. They will almost certainly survive whatever comes next. The S&P 500 is self-cleansing. When a company becomes weak, it gets removed from the index. When a company becomes strong, it gets added. You are always owning the best of American business, automatically, with no effort on your part. And the returns have been remarkable. Over the past century, the S&P 500 has returned about 10% per year on average. That includes the Great Depression. That includes the crashes of 1973, 1987, 2000, 2008, 2020. Despite all of those horrific periods, 10% average annual returns. Now, 10% is the nominal return. After inflation of about 3% historically, you are looking at 7% real returns. That is the power that will grow your portfolio even while you are withdrawing from it in retirement. The other 10% goes into short-term government bonds or a money market fund. This is your stability bucket. This is the money you draw from during market downturns, so you never have to sell stocks when they are down. 2 years of living expenses in safe, liquid assets gives you the flexibility to ride out any crash without touching your stock portfolio. That is it. 90% stocks, 10% short-term bonds. That is the allocation that works. Now let me address the objections because I know they are coming. Objection number one, Warren, 90% stocks is too aggressive for a 65-year-old. All the experts say to reduce stock allocation as you age. Let me tell you what the experts are really saying. They are saying that because you are older, you should accept lower returns. They are saying that because you are older, you should guarantee that inflation will erode your purchasing power. They are saying that because you are older, you should increase the probability that you will run out of money. Does that sound like good advice to you? The conventional wisdom that you should shift to bonds as you age comes from a fundamental misunderstanding of risk. It assumes that short-term volatility is the main risk retirees face. But it is not. The main risk is longevity risk, the risk of outliving your money. And bonds do not protect against longevity risk. Only the superior long-term returns of stocks can do that. I am 94 years old. My instructions to the trustee of my wife's inheritance are to put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. If that allocation is appropriate for my wife's money after I am gone, why would it not be appropriate for you at 65 with potentially 30 years of retirement ahead of you? Objection number two, what about the sequence of returns risk? If the market crashes right after I retire, I could be ruined. This is a legitimate concern and is why I recommend keeping 10% in short-term bonds or cash. That gives you about 2 years of living expenses that you can draw from during a market downturn without selling stocks at depressed prices. Let me walk through the worst-case scenario. You retire at 65 with $500,000. 90% or $450,000 goes into stocks. 10% or $50,000 goes into short-term bonds. The day after you retire, the market crashes 40%. Your stock portfolio drops from $450,000 to $270,000. That is painful. That is scary. But here is what you do. You do not sell a single share of stock. You live off the $50,000 in bonds while the market recovers. Historically, the market has recovered from every crash within 3 to 5 years, usually faster. So during those recovery years, you are drawing down your bond allocation, maybe $25,000 per year if that is what you need to live on. After 2 years, the market has likely recovered substantially. Your stocks might be back to $350,000 or more. And now you can rebalance selling some stocks to refill your bond bucket. The key is having that buffer. The key is never being forced to sell stocks at the bottom. If you have 2 years of expenses in safe assets, you can ride out any storm. Objection number 3. I cannot handle the emotional stress of watching my portfolio drop 40%. I would panic and sell. This is an honest objection, and I respect it. But let me ask you something. If you cannot handle temporary declines in your portfolio value, can you handle running out of money at 85? Can you handle watching your bond-heavy portfolio lose purchasing power year after year to inflation? Can you handle the stress of knowing you played it too safe and now your money will not last? The emotional discomfort of volatility is real, but it is temporary. The consequences of an inadequate portfolio are permanent. You have to choose which discomfort you are willing to bear. And here is something else. If you understand what you own and why you own it, the volatility becomes much more bearable. When the market drops, you are not losing money. You still own the same number of shares in the same 500 companies. Those companies are still selling products, still earning profits, still paying dividends. The market is just offering you a temporarily lower price if you want to buy more. That is not a crisis. That is an opportunity. I have lived through 14 major market declines. Each one felt like the end of the world while it was happening. Each one was followed by new highs. If you can train yourself to see crashes as temporary events rather than permanent losses, you can handle the volatility and you can earn the higher returns that come with it. Objection number 4. But bonds provide income. Do I not need income in retirement? This is a common misconception. Stocks provide income too, in the form of dividends. The S&P 500 currently yields about 1.5% in dividends. That is not as high as bond yields, but it is income. And here is the key difference. Dividend income grows over time. Bond income does not. Let me give you an example. If you buy a bond yielding 4%, you get 4% forever, no matter what happens to inflation. In 20 years, that 4% buys much less than it does today. But if you own the S&P, 500 companies raise their dividends over time. The dividends grow at about 5 to 7% per year on average. That 1.5% yield today might become a 3% yield on your original investment in 15 years. And the principal is growing too. So your total return, dividends plus appreciation, far exceeds what bonds can provide. The obsession with current yield is another mistake that leads retirees into inadequate portfolios. Total return matters more than current income, and stocks provide superior total returns over the long term. Objection number 5, what about diversification? Should I not own international stocks, real estate, commodities, alternative investments? Diversification is valuable, but it can be overdone. The S&P 500 is already incredibly diversified. 500 companies across 11 sectors of the economy. Many of these companies are multinational corporations that derive half or more of their revenue from outside the United States. When you own the S&P 500, you already have significant international exposure through the global operations of American companies. Could you add some international stocks? Sure, maybe 10 or 15% of your stock allocation. It will not hurt, and it might help slightly. But it is not necessary. And the simplicity of owning just one fund has enormous value. You do not have to rebalance between asset classes. You do not have to decide how much to put in Europe versus Asia versus emerging markets. You do not have to second guess yourself constantly. You just own American business and let it compound. Real estate, commodities, alternatives, these add complexity without adding much benefit for most investors. They have fees, they have complications, they require expertise to evaluate. For the average retiree, they are distractions. Stick with what works. Stick with what is simple. Stick with the S&P 500. Now let me talk about implementation. How do you actually do this? Step 1, choose your fund. You want an S&P 500 index fund with the lowest possible expense ratio. Vanguard, Fidelity, and Schwab all offer excellent options with expense ratios of 0.03% or less. That means for every $10,000 you invest, you pay $3 per year in fees. That is it. No commissions, no loads, no hidden costs. Step 2, set your allocation. 90% in the stock index fund, 10% in a money market fund or short-term treasury fund. If you have $500,000, that means $450,000 in stocks, $50,000 in short-term bonds or cash. Step 3, determine your withdrawal strategy. The 4% rule is a reasonable starting point. You can withdraw 4% of your portfolio in the first year of retirement, then adjust for inflation each year. With $500,000, that is $20,000 in year 1. Add Social Security and any pension income, and that is your retirement budget. Step 4, rebalance annually. Once per year, check your allocation. If stocks have grown and now represent 95% of your portfolio, sell some stocks and buy more bonds to get back to 90-10. If stocks have dropped and now represent 85%, sell some bonds and buy more stocks. This automatic rebalancing forces you to buy low and sell high. Step 5, ignore the noise. Turn off financial television. Stop reading daily market commentary. Do not check your portfolio more than once a month, preferably once a quarter. The day-to-day fluctuations are meaningless. All they do is tempt you to make changes you should not make. That is the entire system. 5 steps. No complexity, no expensive advisors, no sophisticated strategies, just ownership of American business in the lowest cost way possible. Let me now share some history that I think is instructive. In 1966, if you had invested in the S&P 500, you would have experienced one of the worst periods in stock market history. By 1982, 16 years later, the market had gone essentially nowhere. People call it the death of equities. Experts said stocks were a terrible investment and you should own bonds and real estate instead. But something interesting happened during those 16 years. Companies kept paying dividends. If you had reinvested those dividends, your actual returns were much better than the flat index would suggest. And then from 1982 to 2000, the market exploded higher. Those patient investors who held on through the tough years were rewarded enormously. The same pattern repeated in the 2000s. From 2000 to 2012, the market went through 2 major crashes and ended up roughly where it started. Another lost decade, people said. Stocks are dead. But again, dividends kept flowing. And from 2012 to today, the market has more than tripled. The lesson is this: there will always be difficult periods. There will always be times when stocks seem like a terrible investment. But over the long term, over 20 and 30-year periods, stocks have always won. They have always delivered superior returns. They have always been the right choice for investors with a long time horizon. And at 65, you likely have a long time horizon. Life expectancy for a healthy 65-year-old is into the mid-80s or beyond. Many people live into their 90s. That is 25 to 30 years of retirement. That is a very long time horizon. That is plenty of time for stocks to work their magic. Now let me address something that I think causes a lot of confusion. The difference between what I do with Berkshire Hathaway's capital and what I recommend for individual investors. At Berkshire, I buy individual businesses. I look for companies with durable competitive advantages, honest and talented management, and reasonable prices. This requires enormous amounts of research, experience, and judgment. It is not something the average person can or should try to replicate. For individual investors, I recommend index funds because they give you broad diversification, professional management, and rock-bottom costs without requiring any expertise on your part. You do not have to pick stocks. You do not have to evaluate management. You do not have to calculate intrinsic value. You just own a piece of everything and let the market do the work. This might seem inconsistent. Warren, you spend your life picking stocks, but you tell everyone else to buy index funds. Why? because I am realistic about what most people can achieve. Stock picking is hard. Even professionals, people who do this full-time with teams of analysts and sophisticated tools, underperform the index more often than they beat it. For amateurs who have careers and families and lives outside of investing, the odds of beating the index consistently are essentially zero. Why try to beat the market when you can simply own the market? Why pay high fees for active management when passive index funds deliver better results at a fraction of the cost? Why take on the stress and effort of stock picking when there is an easier path that works just as well or better? I pick stocks because that is my job. That is what I have spent my entire life learning to do. For everyone else, index funds are the answer. They are one of the greatest financial innovations of the 20th century, and they are the foundation of the portfolio allocation I am recommending today. Let me talk about something else that I think is critically important. The role of Social Security in your retirement plan. Social Security is an incredible benefit that most people do not fully appreciate. It is an inflation-adjusted annuity guaranteed by the federal government. You cannot outlive it. The payments increase with inflation. And for most retirees, it provides a substantial base of income. The average Social Security benefit is about $22,000 per year. For higher earners, it can be $35,000 or more. That is a significant amount of guaranteed inflation-adjusted income that you do not have to generate from your portfolio. When you combine Social Security with a stock-heavy portfolio, you get the best of both worlds. Social Security provides stability, predictability, and inflation protection. Your stock portfolio provides growth, flexibility, and a hedge against the risk of Social Security benefits being reduced in the future. This is why I can recommend 90% stocks with confidence. You are not depending entirely on your portfolio for income. You have Social Security as a foundation. Your portfolio is supplementing that foundation and providing growth for future needs. If you did not have Social Security, if you were depending entirely on your portfolio, I might recommend a slightly more conservative allocation. Maybe 80% stocks, 20% bonds. But with Social Security providing a base of income, 90% stocks makes sense. Let me also talk about when to take Social Security, because this interacts with your portfolio strategy. You can take Social Security as early as 62, but your benefits are permanently reduced. You can wait until your full retirement age, currently 67 for most people, and get your full benefit. Or you can delay until 70 and get about 30% more than your full benefit. For most people with adequate savings, delaying until 70 is the right choice. That 30% increase is guaranteed, inflation adjusted, and lasts for the rest of your life. There is no investment that can match that risk-adjusted return. So here is how I would think about it. If you retire at 65, live off your portfolio and any other income sources until 70, then start Social Security at the maximum benefit. The 5 years of portfolio drawdown is more than offset by the permanently higher Social Security payments you will receive for the rest of your life. This strategy requires some buffer in your portfolio to bridge the gap, but with a 90% stock allocation that is likely growing over those 5 years, most retirees can make it work. And the payoff is a much higher guaranteed income stream, starting at 70. Now let me close with something that I think is more important than any of the financial details I have shared. Your portfolio allocation matters. Getting it right can mean the difference between a comfortable retirement and a stressful one. But money is not the point of retirement. Money is the tool that allows you to live the retirement you want. The point of retirement is spending time with family. The point is pursuing interests you never had time for during your working years. The point is giving back to your community. The point is enjoying the freedom you have earned after decades of work. I have known people with modest portfolios who had wonderful retirements because they had rich relationships and meaningful activities. And I have known people with enormous portfolios who were miserable because they had neither. The allocation strategy I have shared today works. It is backed by decades of evidence. It is simple to implement, and it gives you the best chance of having your money last through a long retirement while still growing over time. But it is just the financial foundation. What you build on that foundation, the life you create, the relationships you nurture, the experiences you have, That is entirely up to you. I hope I have given you something valuable today. Not just a portfolio allocation, but a way of thinking about retirement investing that cuts through the noise and focuses on what actually matters. Not volatility, but long-term returns. Not complexity, but simplicity. Not fear, but confidence based on historical evidence. 90% in a low-cost S&P 500 index fund, 10% in short-term bonds or cash, rebalance once a year, ignore the noise, stay the course. That is the only portfolio allocation that actually works after 65. And now you know it too. But let me go deeper on something because I think it deserves more attention. The psychology of being a stock investor in retirement is fundamentally different from the psychology of being a stock investor during your working years. And if you do not prepare yourself mentally for this difference, you will fail even with the right allocation strategy. When you are working and accumulating wealth, market downturns are actually good for you. They allow you to buy more shares at lower prices. Every paycheck that goes into your retirement account during a bear market is buying shares on sale. You might not enjoy watching your account balance go down, but rationally you know that lower prices today mean higher returns tomorrow. In retirement, the psychology flips. You are no longer adding money, you are withdrawing money. And when the market drops and you are withdrawing, it feels very different. It feels like you are selling at the worst possible time. It feels like you are locking in losses. It feels like your nest egg is being destroyed. This is where the 10% bond allocation becomes crucial, not just financially, but psychologically. If you know you have 2 years of expenses in safe assets, you know you do not have to sell stocks during a downturn. You can draw from your bonds while your stocks recover. This knowledge, this certainty, is what allows you to stay calm when the market is crashing. But you have to internalize this before the crash happens. You cannot wait until you are in the middle of a 40% decline to figure out your strategy. By then, your emotions will be running the show, and emotions are terrible portfolio managers. So here is what I recommend. Before you implement this allocation, before you put 90% of your money into stocks, sit down and visualize the worst case scenario. Imagine the market drops 50% the day after you retire. Your $450,000 in stocks becomes $225,000. Your total portfolio drops from $500,000 to $275,000. How does that feel? Can you handle it? Now visualize what happens next. You draw from your bond allocation, $25,000 per year, let us say. After 2 years, your bonds are exhausted, but the market has recovered. Your stocks are back to $350,000. You sell some stocks to rebuild your bond bucket, and you continue on, perhaps a little shaken, but financially intact. If you can visualize this scenario and accept it as a possibility, you are ready for a 90% stock allocation. If you cannot, if the very thought of a 50% decline makes you physically ill, then perhaps you need a more conservative allocation, maybe 80-20 or 70-30. You will likely have lower returns over the long term, but you will also have less volatility to endure. There is no shame in choosing a more conservative allocation if that is what you need to sleep at night. The best allocation is the one you can actually stick with. A 90% stock allocation that you abandon in a panic during a crash is worse than a 70% stock allocation that you hold through thick and thin. Know yourself, be honest about your temperament, and then choose accordingly. Let me also talk about something that trips up a lot of retirees, the temptation to time the market. You watch the news. You see the market hitting new highs. You think, this cannot continue. I should sell some stocks and wait for a pullback. Or you see the market dropping, you think, this is going to get worse. I should sell now and buy back lower. This is a trap. I have been investing for over 80 years, and I cannot time the market. Nobody can. The people who claim they can are either lying or lucky, and luck eventually runs out. Here's what actually happens when you try to time the market. You sell because you think the market is too high. The market keeps going up. You feel foolish and eventually buy back at higher prices. Or you sell because you think the market's going to crash. It does crash. You feel smart, but then you wait for it to go lower before buying back. It does not go lower. It rebounds. You miss the recovery. You buy back at higher prices than you sold. The studies on this are conclusive. Investors who try to time the market underperform buy and hold investors by significant margins. The market's best days often come immediately after its worst days. If you were out of the market trying to avoid the worst days, you also miss the best days. And missing the best days devastates your long-term returns. So do not try to time the market. Do not adjust your allocation based on what you think the market's going to do. Set your allocation, rebalance once a year, and otherwise do nothing. Doing nothing is actually the hardest part of investing. Everyone wants to do something, but doing something is usually counterproductive. Let me share another piece of wisdom that has served me well. Ignore predictions. I mean all predictions. From economists, from strategists, from analysts, from pundits, from gurus. Ignore them all. I have been hearing predictions my entire investing life. The market is going to crash. The market is going to boom. Interest rates are going up. Interest rates are going down. The dollar is going to collapse. Inflation is going to spike. Deflation's coming. A recession's imminent. Growth is accelerating. Most of these predictions turn out to be wrong. And even when they are right, the timing is usually off. Someone predicts a recession, and it comes 3 years later. Were they right or wrong? Does it matter if you sat in cash for 3 years waiting for it? Here's the truth about predictions. They tell you more about the predictor than about the future. They reflect the predictor's biases, fears, hopes, and marketing needs. They do not reflect what is actually going to happen, because nobody knows what is actually going to happen. The future is inherently unpredictable. There are too many variables, too many interconnections, too many random events. Anyone who claims to know what the market will do next year is either deluding themselves or trying to delude you. So what do you do in the face of this uncertainty? You own a diversified portfolio of excellent businesses. You hold it for the long term. You ignore the predictions and the noise. And you trust that over time, these businesses will grow and prosper, and your ownership stake will become more valuable. That is not a prediction. That is a statement about how capitalism works. Businesses exist to generate profits. Profitable businesses become more valuable over time. Owning profitable businesses makes you wealthier. This is as close to a sure thing as exists in investing. Now let me address one more topic that I think is important. Fees. I have mentioned low-cost index funds several times, but let me be more specific about why fees matter so much. Let us say you have two investment options. Both are S&P 500 index funds. Both will deliver the same gross returns because they own the same stocks, but one charges 0.03% per year in fees, and the other charges 1% per year in fees. That difference seems small, 0.97%, less than 1%. What is the big deal? Over 30 years, with a $500,000 portfolio earning 8% gross returns, the difference is enormous. The low-cost fund leaves you with about $4 million. The high-cost fund leaves you with about $3 million. You have lost $1 million to fees. $1 million that could have funded years of retirement. Gone. Paid to some fund company for doing essentially nothing. This is why I am so emphatic about low-cost index funds. The fee difference is not trivial. Over a multi-decade retirement, it is life-changing amounts of money, and it gets worse. Many financial advisors charge 1% per year on top of whatever the funds charge. So now you are paying 2% per year or more. Over 30 years, that could cost you half of your potential wealth. Half. This is why I recommend that most people do this themselves. Open an account at Vanguard or Fidelity or Schwab. Buy their low-cost index funds. Pay 0.03% in fees and nothing else. Do not pay an advisor 1% per year to tell you to buy the same index funds you could buy yourself. If you truly need help, if you cannot manage your own finances, there are fee-only financial planners who charge a flat fee or hourly rate rather than a percentage of assets. They will help you set up your portfolio and create a plan, and then you can manage it yourself going forward. That is a much better deal than paying 1% per year forever. Fees are the silent killer of retirement portfolios. They compound against you just as surely as returns compound for you. Minimize them relentlessly. Let me also say something about the role of luck in all of this. I have been extraordinarily fortunate in my life. I was born in America in a time of unprecedented prosperity with talents that happened to be highly valued in our economic system. None of that was my doing. It was luck. If I had been born in a different country or in a different era or with different abilities, my life would have been completely different. I might have been a farmer or a factory worker or unemployed. The skills that made me wealthy in 20th century America would have been worthless in medieval Europe or ancient China. When it comes to retirement investing, luck plays a role too. The person who retired in 1982, just before one of the greatest bull markets in history, had a very different experience than the person who retired in 2000, just before a decade of poor returns. Same strategy, same discipline, wildly different outcomes. You cannot control your luck. You cannot control when you were born or what the market does the day you retire. All you can control is your process, having the right allocation, keeping costs low, staying disciplined, rebalancing regularly, not panicking. If you get the process right, good luck will make you wealthy and bad luck will still leave you okay. If you get the process wrong, even good luck might not save you. So focus on what you can control, get the allocation right, keep fees low, stay the course, and let the chips fall where they may. I want to end with a thought about what retirement is really for. It is not about accumulating the largest possible pile of money. It is not about beating some benchmark or outperforming your neighbor. It is about having enough to live with dignity and freedom for the rest of your life. Enough is a powerful concept. It means you can stop worrying about money. You can focus on what actually matters. Family, friends, health, experiences, giving back. The portfolio allocation I have shared today is designed to give you enough, not the maximum possible return, not the lowest possible volatility, just enough to fund a good retirement with high probability. That is all any of us really need. Not more, just enough. 90% in a low-cost S&P 500 index fund, 10% in short-term bonds or cash. Simple, effective, and time-tested. That is the only portfolio allocation that actually works after 65. Now go live your retirement. The finances are handled. The rest is up to you.